This is the weekend conversation that actually matters. We are not recapping news you already heard. We are building the full macro roadmap for next week, and there's one single key level that links all 8 major assets together right now. The US dollar index is trapped hard at 104.80, while the S&P 500 sits precariously on a gamma ledge at 5,280. These two pivotal levels will decide everything: whether currency longs get wiped out, whether gold stages a major breakout, and whether Bitcoin faces a sharp collapse. Every asset on my macro board is interconnected. By the end of this video, you'll have the exact institutional trading blueprint Wall Street is building this weekend. Write these levels down now: DXY 104.80 and S&P 500 5,280. If these levels break, the market dominoes fall in a clear, predictable sequence, and I'm going to walk you through that full sequence step by step. The core bias for next week leans toward a US dollar fade from overhead resistance, which would be risk positive for equities, commodities, and major foreign currencies, but only if incoming economic data cooperates. We are heading into a packed week: US CPI, UK CPI, China activity data, plus a full lineup of central bank speakers. The market is already priced in for dollar softness, yet positioning is dangerously one-sided. The DXY weekly chart prints a lower high at 105.20, with the critical 200-day moving average acting as an impenetrable wall right at 104.80. The daily MACD is already rolling over. To the downside, for hot inflation print pushes DXY above 105.20. To the upside, the entire macro thesis flips on its head. That would crush euro to US dollar, send pound sterling to US dollar plunging below 1.2400, and force gold back down toward 2,300. That's your official macro invalidation level. Conversely, if DXY closes the week below 104.80 and the S&P 500 holds firm above 5,280, the liquidity tide remains supportive, and risk assets will resume their rally. This is your primary macro lens for the week ahead. Now let's connect every asset to map the full market web. The US dollar index and S&P 500 are the backbone of global risk sentiment, currently holding an inverse correlation coefficient of -0.7. DXY is forming a clear head and shoulders top on the 4-hour time frame, with the right shoulder perfectly marked at 104.80. The 60-day moving average provides immediate support at 104.40. A clean break below this level opens a drop toward 103.60, setting up the perfect setup for dollar bears. The S&P 500, meanwhile, is clinging to its 50-day moving average support at 5,280. Friday's candle printed a bearish engulfing rejection right at 5,350. Market breadth has been quietly deteriorating, with the percentage of stocks trading above their 50-day MA falling to just 52% last week. Gamma exposure data reveals a massive dealer put wall sitting at 5,250. If the S&P closes below 5,280, dealers flip into short gamma, accelerating downside pressure toward 5,190, marking a full reversal in the liquidity tide. The simple relationship to remember: if DXY breaks below 104.40 and the S&P holds 5,280, go long across all risk assets. If DXY spikes above 105.20 and the S&P loses 5,280, move to cash and target short entries. This is the first domino that dictates all other markets. The dollar killers: Euro to US dollar and GBP USD. The euro and British pound are both fighting dollar strength, but with vastly different fundamental and technical backdrops. EUR/USD is pinned firmly below its 200-day moving average at 1.0880, with a daily double top formation and key neckline support at 1.0850. The 4-hour MACD shows clear negative divergence. Price made a higher high Thursday, while the histogram printed a lower high. ECB minutes confirmed policymakers are now more concerned about growth than inflation. A clear dovish tilt weighing on the euro. GBP/USD is in an even more vulnerable position. It rejected the 200-day MA at 1.2640 on Friday with a long upper wick candle, and the daily chart just triggered a death cross. The 60-day moving average crossed below the 200-day. Critical triple support sits at 1.2520, holding 3 times since April. A break here opens a drop to 1.2400, with further downside targeting 1.2320. The key divergence. Euro to pound sterling broke below 0.8550, confirming sterling is outperforming the euro. The Bank of England retains a hawkish lean, with MPC members reiterating sticky UK services inflation rules out a June rate cut, while the ECB is slowly pivoting dovish. In a weak dollar scenario, pound sterling to US dollar will outpace euro to US dollar to the upside. In a strong dollar scenario, cable will fall much faster. Watch Wednesday's UK CPI closely. A weaker print will erase both hawkish pricing and smash straight through 1.2520. Trade bias. Sell euro to US dollar toward 1.0880. Sell pound sterling to US dollar toward 1.2600, unless DXY breaks 104.40. In which case by pound sterling to US dollar dips at 1.2520. Intervention ghost. US dollar to Japanese yen and Nikkei 225. This is the most dangerous pair on the entire macro board. US dollar to Japanese yen is hovering at 156.40, the exact level where Japan's Ministry of Finance has historically launched currency intervention. Friday's sharp intraday reversal was an obvious warning shot for bulls. The 4-hour chart forms a head and shoulders top with neckline support at 155.80, and the MACD is crossing into bearish territory. The US-Japan 10-year yield spread compressed 5 basis points Friday as JGB yields tick higher. This yield compression is the intervention ghost, not actual policy action, but the fear of it driving safe haven yen buying. Most traders miss the hidden confirmation. The Nikkei 225 failed at 38,200 Friday and is breaking down from a wedge pattern, also printing a daily death cross. 25-day MA below 75-day. Foreign investors sold 420 billion yen in Japanese equities last week. USD or JPY and the Nikkei hold a strong 0.87 correlation. If the Nikkei breaks 37,800 this week, it will drag US dollar to Japanese yen below 155.80 within hours, creating a dangerous feedback loop. A weak yen boosted Japanese exporter stocks. Intervention fears. Strengthening the yen triggers Nikkei selling, which then fuels more yen safe haven demand. Weekly bias. Short US dollar to Japanese yen targeting 153.50. Invalidation. Daily close above 157.00. Always respect the MOF. Any overnight Tokyo headline can wipe out positioning instantly. The Australian dollar is facing serious structural downside pressure. Australian dollar to US dollar closed below its 200-day MA at 0.6610 for 3 straight sessions, a confirmed technical breakdown. The daily MACD is accelerating lower, and the 60-200 moving average death cross is now active. Iron ore futures dropped another 3%, while RBA minutes flagged deep concerns over China's property sector. This week's Chinese industrial production and retail sales data are make or break. A downside miss won't just test 0.6500, it will spike straight through it toward the 0.6410 liquidity pool, matching the 61.8% fib retracement and the bottom of the weekly Ichimoku cloud. Cross-asset confirmation comes from copper and the ASX 200. Copper is failing to make new highs, and the ASX 200 is rolling over. Australian dollar to US dollar remains the purest live proxy for China risk sentiment. A break of 0.6550 confirms further downside. Aussie futures hold extreme crowded short positioning, creating major short squeeze potential if China data surprises to the upside, but the path of least resistance remains lower. Fade rallies toward 0.6585 at the broken 60-day MA, the fear architect and geopolitical heartbeat. Gold and oil. Now we connect the two assets that price global fear and geopolitical risk. Gold is the fear architect. WTI crude is the geopolitical heartbeat. Gold should have sold off last week. 10-year TIPS real yields rose 4 basis points, a typical headwind for bullion. Yet gold held firm at 2,350 and closed above its 20-day moving average, all driven by a strong geopolitical bid. Strait of Hormuz tensions escalated sharply, and gold ETF inflows surged 12 metric tons just on Friday. The daily chart is consolidating inside a bullish flag pattern with an apex at 2,380. A weekly close above this level opens a rally to 2,440. followed by a retest of the all-time high at 2,485. Moving averages remain bullishly aligned, 50-day above 200-day, price holding above the 50-day MA. Daily MACD is curling higher from a zero line, and the 4-hour RSI still has room to rise towards 70. Oil trades off the same geopolitical catalyst. WTI is trapped inside a symmetrical triangle, bounded by the 200-day MA at 78.80 and the 60-day MA at 80.50. The daily MACD just crossed bullish, and crude inventories drew down 3.2 million barrels. If Middle East risk premium spike, gold and oil will break out in tandem. A clean break above 2,380 in gold and 81.20 in WTI delivers a joint risk premium repricing, the strongest by signal for both assets. A breakout in one without the other weakens the trade setup. 0.12 week bias. Long gold above 2,350. Long WTI above 79.50. Invalidation levels. Gold daily close below 2,310. Oil close below 78.40. Risk asset shadow. Bitcoin is the most intriguing chart of the week, now actively decoupling from the S&P 500. The 30-day rolling correlation dropped from 0.8 to just 0.45. Friday saw the S&P close flat, while Bitcoin dropped 2.3%, a clear divergence. The weekly chart is capped below the legendary 200-week moving average at 69,800, a critical bull-bear pivot level. The daily chart prints a head and shoulders pattern with key neckline support at 68,200. Perpetual swap funding rates flipped negative for the first time since February, signaling overwhelming short positioning, often a contrarian squeeze signal in a bull market. Spot Bitcoin ETF flows reversed Friday with $120 million in outflows, ending a long streak of inflows. If the S&P holds 5,280 and rallies, Bitcoin squeezes hard toward 72,000. If the S&P breaks 5,280, Bitcoin leads downside and fills the CME gap at 65,400. Key level to watch, 68,200. A daily close below confirms the bearish thesis. A reclaim above 69,800 invalidates it entirely. Monitor early week correlation closely. If stocks rally and Bitcoin lags, crypto-native selling pressure is deepening. 3 Weekend trade blueprints. Most viewers watch weekend finance videos for entertainment. You're here for an actionable plan. I'm giving you 3 institutional-grade trade blueprints aligned with the full macro map we just broke down. High conviction dollar fade if DXY opens near 104.80 and rolls over. Short the dollar index, or go long euro to US dollar above 1.0855. Stop loss at 1.0810. Target 1.0980. Gold flag breakout set an alert at 2,382. Enter long on a 4-hour close with rising COMEX volume. Stop at 2,365. Target 2,415. Then trail stops toward 2.40 to USD. A JPY intervention fade if US dollar to Japanese yen rallies to 156.40 and stalls with a 1-hour bearish engulfing candle. Enter short with stop at 156.85. Target 155.00, then extend to 153.50. All 3 trades align with our core macro thesis. Dollar weakness, geopolitical safe haven demand, and Japanese yield compression. Drop your top trade for next week in the comments, asset and direction. I read every single comment Sunday night. Risk management pulse. This is the only rule that keeps you in the game long term. Never risk more than 1 to 2% of your trading account on any single setup. Next week is loaded with high-impact data. US CPI, UK CPI, China activity prints. Avoid holding open positions through major news unless you've locked in profits with a trailing stop. Stop losses are non-negotiable. That if DXY invalidates the setup with a close above 105.20, cut all dollar short positions immediately. Never hold and hope for a reversal. We've mapped the entire 8-asset macro landscape. The single linchpin level controlling everything is DXY 104.80. Holds as resistance. Risk assets rally. Breaks higher liquidity drains, and every market we covered flips bearish. Tomorrow morning ahead of the Sydney Open, I'll drop the daily breakdown on the first mover asset, usually Australian dollar to US dollar or US dollar to Japanese yen. Turn on channel notifications so you don't miss it. If You want to dive deeper into last week's Bitcoin and S&P 500 divergence? The full detailed video is linked on the end screen right now. Hit the like button if this weekend macro map gave you clear trading clarity. Subscribe for daily institutional level coverage of all 8 assets every single week. I'll see you in the pre-market live session. Trade disciplined. Trade prepared.